Good morning. This is Jim Barlow with OakTree Strategic Leverage. It's a beautiful morning here in Utah, and it's not afternoon yet. It's 11. Hopefully, we don't get that far. Inversion thinking, business succession. It's been a long time since I did business succession one. I hope this is helpful. Let's get started. Um, I'm probably always going to do this. A little bit about me. I'm from Clearfield, Utah. I went to Clearfield High, grew up here. My wife's Barbara. We have 7 children, 28 grandchildren. I'm a BYU graduate, big fan. I was an investment advisor for 35 years, and we have a lot of things we love to do. We love to travel. We love to visit loved ones, enjoy family events. We read, we attend plays, we treasure time with family. We serve in the temple. We're striving to be disciples of Jesus Christ. And OakTree is really part of me believing in trying to do good and helping others. The picture is from our reunion, family reunion 2 years ago. We have one every 2 years. This is in Heber Valley. We'll be doing one in Bear Lake in July, and we'll have another group picture. There'll be a few more people. That's how it goes. So, inversion thinking. What is inversion thinking? Win without losing. Most people try to win. Few build systems that can't lose. Of course, you're probably wondering if that's possible. Well, it is. What is inversion thinking? It's a way of solving problems backward. Instead of asking, how do I succeed? You ask, what would cause this plan to fail? Then you eliminate those risks first. The power of inversion. Charlie Munger of Berkshire Hathaway was probably one of the biggest proponents of inversion thinking. He said it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Remove the causes of loss and progress compounds. Another quote, probably the leading quote, often quoted by Charlie Munger, is from Carl Jacobi. Invert, always invert. Look at the opposite side. Nassim Nicholas Taleb, I believe I'm saying that right, he said the first rule of risk management is to avoid ruin. That's a good one. I put a lot of quotes together from looking at lots of quotes. These looks like the 5 biggest bullet points that these people look for. Avoid ruin, eliminate mistakes, see hidden risks, build durable systems, let time compound. If you like a copy of my 100 plus now inversion quotes, send me an email or text, and I'll be happy to send you one. LaVelle Edwards said, football games are usually won by the team that makes the fewest mistakes. You know, that's almost just logical. Championship teams focus first on eliminating turnovers, penalties, assignment mistakes, mental errors. If you're a football fan, you know you can see it happening because most games are lost by mistakes, not won by heroics. Great coaches, and he's not the first one to say this, no, start by asking, not by asking how to win, but start by asking, how do I avoid losing? And that's those 4 bullet points of what they do. The iceberg of wealth. Probably could have done this earlier in the presentation, but what you see is only a fraction of what's out there. What you don't see determines everything. Start where others don't. Instead of asking how to succeed, ask what causes failure, then eliminate it. What actually destroys financial outcomes? No structure, delayed decisions, behavior that weakens structure, unfunded obligations, market losses at the wrong time, taxes, business succession failure. That's our topic for today. I got thinking just yesterday, and so I put this slide together. Delayed decisions on known problems. No real estate plan. State decides. Delayed decisions, you know what the different word for that is? Procrastination. 2/3 do not have a will or estate plan in our country. 2/3. I'm shocked. That's just shocking. The no buy sell plan. Okay, business owners, what percent of you have a buy sell plan? 2/3 don't. About the same percent. I don't know what that means. 2/3. Here's all the other ones. One other one I want to point out: ignoring long-term care. About 2/3. Ignore long-term care. Hope things work out. Delayed life insurance, cost is going to go up. Uninsurability option. A lot of the problems we have in life is self-made. Procrastination. The pattern, I'll do it later. Fewer options, higher costs, less control. The inversion of wealth framework. This is something we patented or trademarked. First, we start with this, what we've been talking about, inversion. Figure out how to avoid ruin. Then you should build a structure that protects you from a lot of those inversion items. Designing it. This is the Kaizen. Then, if this is all in place, you can do some leverage, multiplication to have things do better. The wealthy do this all the time, and then you can have some, just sit around and be patient, and this thing works wonders. Inversion wealth framework. You know, let's look at it from an oak tree of all things. We've got the roots, we've got the trunk, the branches, and the leaves. Well, look here, inversion, looking at the roots. What could go wrong here? The structure, the trunk, the branches, the leverage, and the leaves. Kind of is a pretty decent analogy. So remove what kills the tree, build strength, expand growth, and results over time. So the inversion wealth framework. I'll refer to it continually, but the inversion is the thought we wanted to get across. Now let's apply the framework to succession planning. Succession plan ensures the right people take over at the right time, in the right way, so the business continues without interruption. Boy, that makes sense. It's the succession plan. Remember, 2/3 don't do it. Hopefully you're the one ready to move. Inversion principle. Most owners ask, how do I exit successfully? Inversion asks, what happens if I don't? Let's find these problems that could really happen. Most businesses have no real succession plan, 2/3. And when there's no plan, value doesn't matter. Value doesn't matter. Liquidity does. The illusion of planning was success supposed to work. Transfer to children. Management buyout, sell to a third party, supported by a buy-sell agreement. You know, I bought my father's business back in 1979. We didn't buy on the seat of our pants, and And I decided not to stay in the furniture business, but I was involved at a pretty young age. I was looking to sell my investment advisory business to a third party. Got options and offers. Eventually, we decided for Scott and Darren to keep it in house per se. Um, we didn't have a buy-sell agreement because I was worried about funding it, things like that. But if you really want to succeed, you got to do this. I didn't quite do it probably right. What breaks succession plans? Death without liquidity. That would be a disaster. Disability of a key owner. Underfunded buy-sell, no, or not funded. Tax shocks, illiquid assets, business downturn during a transition. There's a bunch of things that can break a succession plan. Succession failure is almost always structural. Putting the plan together, getting the paperwork together. The real risk, buy-sell agreements often are underfunded or not funded, depend on future cash flow, depend on borrowing, not a fun option, trigger forced sales. Inversion asks, what happens if death or disability occurs at the worst possible time? Let's don't procrastinate. What succession truly requires? Create a liquidity on demand. Maintain operational stability, protect surviving owners, equalize heirs if that's part of the plan, avoid forced sale, remove tax friction. Where insurance-based structure enters? Well, key person, protecting the business, the buy self-funding. That's probably the main one we'll be talking about today a little bit. Estate equalization, supplemental executive plan, a leverage structure, which covers all of them, which is Kaizen. Insurance isn't about death, really. It's about liquidity timing, having the money when that business needs it. So how does Kaizen fit in? One, it is a life insurance chassis. It creates the liquidity. And the leverage that I'm going to show you creates larger, more money, larger funding pool. And this structure, a lot of the risks are taken away. So now we're going to get into Kaizen. Probably can't give you all, but I'll try. These next few slides I've used forever. I tweak here and there, but basically are the same. There's the protection part, there's the growth part, and the control part. We're going to do them one by one. Protection. It is a life insurance policy. So you have the immediate liquidity if one of the owners of the company passes away. And there's living benefits. Probably just as important, you have protection against disability, against injury, against disease, and you have even a long-term care protection, protections that a lot of people do not have in life. So you have the death benefit, you have a living benefit, and tax-free growth. When someone passes away with a cash value life insurance policy, goes to the heirs tax-free. Boom. Well, it is a tax-free vehicle, and as the owner of a policy, it grows tax deferred, and you can borrow from the policy tax-free. Access tax-free. You can literally have tax-free investment. That's how tax-free happens. Build-in efficiency. You're not paying an advisory fee or a management fee and say insurance policy. You are paying insurance. And I'll cover that in just a few minutes. But just the death benefit, tax-free, and cost efficiencies. That's the protection. Then we have the growth. We're using the index universal life policy. I don't have that printed anywhere. I probably should. Market-linked growth. Participate in market gains. You basically a market-linked growth with no downside risk. Market losses, there's none. There's zero. It can't have any. My next slide is going to show you how that happens. But because if you had a 2008 with a negative 37%, after the year in 2009, you've got to start growing from down 37%. We don't have that. We have continuous compounding, no losses, gain, grow without recovery years. Let me show you how they do this. Beyond the insurance costs, if there's added money going into the cash value portion, the majority is going into the insurance company's general account. And this consists of high-grade bonds, U.S. government bonds, high-grade corporate bonds. Out of $1,000 in a 5% world, 952 is going into the general fund. And at this 5% interest world, that'll grow to $1,000 1 year from now. That's how we protect and have zero downside. The $48, what's left, is what we use. We buy options to replicate indexes, the market. So you can be in a market performing like instrument with no downside. This is inverse thinking for sure. Last is the control, structural advantages. I put 5. They've actually built a bunch of them. But let's start with institutional leverage. Greater growth with less personal capital, and it's controlled leverage. You'll see in a moment. Not outrageous. Finite funding. You, the investor, the client, the business owner, 5 years of planned contributions. Done. No more. You can see yourself to doing it. Protected ownership. We set things up in a trust ownership with a master trust that controls the everything and does the borrowing, does all the monitoring, and you actually have a protection against creditors because of the way this is owned and set up. Turnkey design. You know, you don't need to worry about the market in here. You already know you have zero negative years. Very turnkey. You could just turn it on and let it go. Flexibility, liquidity. Access to cash value, no forced withdrawals. For the first few years, well, let's say, let me give it 15 years. That's not few. For the first 15 years, you need to stick with it. If you can't do that, then don't do this. After that, you have more flexibility and liquidity than you can imagine. You can have access to cash without taxes, no requirement minimum distribution rules and IRAs. Flexibility, no now, flexibility, great later. There's the 5: leverage, limited funding, protected, turnkey. Here's a visual on your 5 payments. Probably not the greatest chart of the world, but it is fun building it. So I've got 5 silver pigs. That's the 5 years. That's the 5 years of your payments if you're the buyer. And about the same time, the bank that we select will be putting in about the five payments similar to yours, a little bit less in most cases. But then after 5 years, they're going to continue the payment they were making for 10 years, and the bank takes over your payment you were making for the first 5 years. It turns out to be about 3 to 1. If you're putting 100,000 in over 5 years, they're putting in 300,000. If you're putting in $1 million, they're putting in 3 million. And you'll get a kick out of this. All without the typical risk of borrowing. There's no credit checks. There's no loan documents. Well, there's no loan documents. There's no personal guarantees. There's no signature on a loan document. There's no collateral. None of this. So you can borrow that $3 million where you put $1 million in, and there's no liability. In a way, this is kind of a halftime. This is the uses of Kaizen. And if you look around there, you'll see that business planning on the left bottom, executive employee retention, and business succession planning. These are all the uses of Kaizen, of the personal wealth, the supplemental retirement, very tax efficient income strategies. There's the business, there's the family and legacy, purchasing on a grandchild or a child, just plain old career protection. So when you buy one, you get them all, you get all the benefits, and you can use it for what you need it for. I've been hinting, yes, there is life insurance and it has a cost, but the structure creates benefits. But unlike investment management fees, it's not charged as a percentage of assets. Insurance costs are based on the death benefit, the face amount, how much you're purchasing, the age of the insured, the health of insured. As an investment advisor, I wanted to have a 1%. You're paying 1%. Well, it varies depending on all these things. These factors determine the underlying insurance charges. The real question is not, is there a cost? You know there is. The real question is, do the benefits of the structure exceed the cost? Insurance chassis allows Kaizen to provide downside protection we've gone over, tax advantage income, tax-free, death benefit protection, safe leverage, and liquidity. So there's some really cool benefits to Kaizen. Every case is tested using illustration or patented illustration software to determine where the benefits exceed the cost. Now I'm going to go in. Let me jump ahead. We're going to do a hypothetical Kaizen profile, and we're going to use our ILIA. If you can read that in the upper left corner, ILIA software. We've got quite a few tools to help investors decide if this is the right thing for them. But this software, the third bullet point on the left is estimate my benefits. I use this software all the time, virtually daily, and I'm going to show you some results. My hypothetical is going to be a 46-year-old male, excellent health, and he's willing to put in $70,000 a year for 5 years. And he wants a distribution when he turns 65, and he wants to make sure it happens through 90. The assumption is we're going to use an illustration rate of 6.81. That's pretty specific. That's controlled by the National Association of Security. Oh shoot! You ever have a brain warp? National Association of Insurance Commissioners. There's one in every state, sorry. I'm going to use an income tax rate combined of 37. I'm going to use the capital gain rate of 20%. And we're going to compare regular investments at 6.81, with Kaizen at 6.81. Everything will be at 6.81. So first, there's my format. I'm going to give you the investment strategy, the beginning income, and how much you're going to take out by 90, and how much death benefit you had at 46, and how much you have left at 90. Oh, I forgot to tell you something. Let me go back. Why did I pick 46? And why did I pick 70,000? That's the average age of a Kaizen investor nationwide. And that's the average contribution of a Kaizen investor nationwide. So 46 and 70 is the average dude buying Kaizen. I forgot to tell you that. So if you put this 70,000 a year for 5 years at 6.81 in a regular after-tax investment, you could start pulling out 58,642. And to do this, I wanted to give this person as high income as possible. So I heard that 90. I've used every penny as earning 6.81 to give them the 58,642. How much do you have left at 91? Zero. So after tax. Next, I've got tax deferred. This is your IRA. This is your 401k. 6.81 can give you more money. You can have 74,106 through 90, and almost what's that? Almost what is 400,000? 400,000 more because you chose a tax deferred investment. Again, it's still not life insurance. So it's just an investment at 6.81. So, drum roll, please. The next line down is going to be the Kaizen. Is it good? 70? We got 58. We got 74. Is it going to be 84, 94, 104? What do you think it could be? And we're doing even a curtain roll. There you can see the answer is roughly 130,000. That's a lot more money than 58 or 74. And we'll have pulled out 3,380,000. We've started out with death benefit of 2 million. We still have 1,700,000 death benefit at 90, and they could keep on pulling money out. There's your Kaizen. So, how much do the insurance cost long term? Looks like it was free. No, it wasn't free, but as if it was free. So you got the death benefit because you got higher income because of the structure and the benefits. Now, we did some stress testing on the two worst case scenarios. We looked at the Great Depression in 30 and 32. Would Kaizen survive this era? And we also looked at the 1980s, the high interest rate environment of the 1980s. Would Kaizen survive the 1980s? Well, you probably know that they do, or I wouldn't be showing it to you. So here we go. The Great Depression, the 30s, 84,500. Well, it's not 130, but worst scenario is better than the 74 or 58. Wow, that's pretty good. And the stress test of the 1980s, not as bad as the Great Depression, 97,500. And guess what? The 58 and the 74, did they have downturn markets then? Sure, they would have been 74 and 58. So stress test, these worked. Kaizen works even in the worst of scenarios better than other options. Now I got another drum roll, please, huh? Well, let me tell you, Allianz is one of our vendors. And they said, we want to analyze your software to see if this software is accurate. and working properly. So they analyzed it, and they came back and said there's an 80% chance that 130,000 year projection, which we do you, is going to be double. Double. 80% chance 130 won't be 130, it'll be 260. Wow. So now we have a range from the worst, 84, to the best, 260,000, at lower risk than the regular world. Now, okay. What I did here, I took this same dude, I very quick call him dude, this 130, and I said, well, what if it had just been average health? How much would that reduce? It had gone down to 120,000. Wow. Not bad, not bad. Now, you do have to be insurable, and you have to be pretty highly rated. Average, excellent is a good way to go. But even then I did a hypothetical. What if this 46-year-old was a female instead? Well, just to let you know, females are more insurable. They'd get 133,000. So we got three different options, giving you some numbers. Now I want to show you some historical performance. The very first policy issued in 2012 of Kaizen, they come out with a statement every year, and the last statement was June 27th of 2025. And this is actually one of the owners of NIW, the designers and founders of Kaizen. And she has averaged 7.85% on her money per year. And she's, remember there is a 3-to-1 borrowing, she's averaged 3.95 on the interest paid. And then we have what we call the spread. So 7.85 subtract 3.95 is 3.9. She's made 3.9 on all the borrowed money. After paying interest and the return, she's borrowed money, OPM. So looks pretty good. 7.85 on her money, 3.9 are all the borrowed money. Going to build up quicker. Long-term historical SP 500. That's pretty much been it. There's years when it's higher, or eras when it's higher and lower. But 10% is higher than 7.85. That makes me sad. But it's tax advantaged. It's going to be tax-free. So 10% times 75%, just saying 25% of taxes at 7.5, boom. More conservative, performing like a market return investment. Oh, I've got these out of order. I want to do that one for, I'll change that. Okay, the Kaizen principle with business succession. Most owners focus on who will take over. Wise owners focus on how the transition is structured, because business rarely fail from lack of interest. They fail from poor transition design and procrastination. The inversion teaches us to ask a better question, not who gets the business, but how does the business survive the transition? Because succession is not an event, it's really a system. You get protected as a structure first, transition second. So we're wrapping up. Oh, I'm doing good on time. There's really 4 ways to learn. First way is kind of on your own. Well, not totally, but we have this landing page, I'll call it, that it has 10 chapters on different sections of the Kaizen. It has lots of videos, and and you can watch it in your free time, your time. There's the QR code to go to this landing page. Everything you want to know about Kaizen. Did I give you enough time for that QR code? The second one is Kaizen, but the twist of gifting it to your children or grandchildren. The premise here is, how do you give money to your kids? Do you just give it to them and they buy the sports car? This is a cool way to give. We have a webinar all about gifting, but there's the QR code. If your interest is gifting, this will kind of go through the same thing with a different slant. Now, there's the ILIA site that I talked about earlier. Eventually, you'll want to come here, but you don't need to initially. You need to have an invitation to go to this site. I need a name and phone number and a few things to give you an invitation. Then you'll have a login up to your account and a password. This is the one I use all the time. Or, I've done it out of order again. This is the one I want first. I've got my website. I think my website is dynamite. I'm working on it all the time. This webinar will be posted on my website. You want to watch it again? You probably can Wednesday. It'll probably be posted by Wednesday. But I got a lot of quick links, retirement income gap calculator, all these different things, explaining things to you. A lot of videos that I've made, webinars. It is that order. One of my things is a retirement income gap calculator. This will help you decide if you're on track. I've got the basic one and advanced that I built and designed. I love them. I think they're perfectly right on. Anyway, a free tool. So how do you engage? You could do those first landing pages. Just study on your own. Call me if you have questions. I'm here to guide you. If you have needs, you can actually go through the whole process without me through this online system. That's the world today. Or you want to go to lunch, go to dinner, want to get together and look it over, I'm happy to do that too. Either way, it doesn't matter. Same strategy, different engagement styles. You're going to have your style that you want to approach this right. It doesn't matter how, your choice. Service model. We've got layers of professional support. There's me. Anytime you have a question or whatever, then there's the program oversight. The strategy is designed by NIW companies. They monitor the structure and coordinate the key parties for absolutely 15 years because the borrowing is 15 years. We have the institutional partners, the insurance company, the lender, we have the master trust. We've got all these entities that are there to support you. I put down at the bottom, even if I'm no longer involved, the institutions behind the strategy continue servicing the structure. Did you hear what I said? Not that I'm saying when it's going to happen, but it all happens to all of us. Anyway, service. This is my webinar series currently. We're on that bi-monthly business succession, the fifth one down. Monthly, I do a flagship just about Kaizen and inversion thinking. Then I do one on retirement income. Then I do one on family gifting. Then every other month I do executive employee benefits, every other month of business succession. Those last three I haven't built yet. This was the first one on business succession. Maybe I'll get working on those and get them built and get ready. But there's my series of inversion thinking and Kaizen, the different eras. Here's the coming up webinars. The first one is April 1st. This is the flagship again. This is the one about Inversion and Kaizen. The second one of the month, April 9th, is about retirement income. The third one is family gifting. And then the fourth one is back to the executive employee benefits. There's the four, and the code at the bottom, if you do a screenshot, that's the invitation to the webinar that you've gone to today. I've actually got two more that are scheduled, the April 30th and the May 5th. The April 30th is back to the flagship one, and then the May 5th is back to the retirement. I didn't go any further. So I hope you've enjoyed listening to me and going over the basic of inversion thinking, succession planning, and Kaizen. And I post all my webinars on my website. You can watch those other ones that we've talked about. There's my phone number, there's my email, my website. There's those two QR codes for those two landing pages. I'm happy to help you anytime you have a need. Anyway, Jim Barlow, it's 11:42. I'm doing pretty good. I wanted to try to do it 30 minutes. I've decided I'm going to always try for 45 now. Have a great day. Bye.